All right, wonderful intro macro students. This is the second part of the 2-lecture series that will cover the last remaining material for this quarter, where we're going to be covering fiscal policy and monetary policy. This is the last part, just the monetary policy. We're also going to talk about money and banking and the Federal Reserve System. So there's a lot of information coming at you, and so I have it in the form of the handout, the notes that I will walk through. And of course, you can have the notes with you when you're working on the homework and taking those quizzes. Absolutely, that's for your benefit. So, all right, without any further ado, I apologize. I had running club tonight, and then we just played hockey. We play basement hockey every night here in our house. It's our exercise. So, whew, I'm a little hot and sweaty, so bear with me. A little out of breath. I may have to take a drink occasionally as I go through this lecture. Hopefully it won't be too long-winded. It is getting a little bit late tonight, and I do want to get this uploaded for you so you can get that homework done. So without any further ado, let me get to my screen sharing. And so hopefully I will share this screen with you. And so monetary policy notes. So remember, just to recall where we're at, if the economy is not in long-run macro equilibrium, it's either in one of two situations. This is the Goldilocks rule, right? Too hot, too cold, just right, okay? And if the economy is not just right, we're either too hot or too cold. And so we need to, if we're too cold, we need to warm it up. If it's too hot, we need to cool it down. And so those are the different policies that we have. 3 ways that we can go about heating up or cooling down the economy to get us to that equilibrium, that long-run macro equilibrium position, are 1, the wait and see approach, and you saw that in the previous video, the fiscal policy video. I talked about the wait and see approach moves the aggregate supply curve. Then we did fiscal policy, and that one moves the aggregate demand curve. And the fiscal policy is determined by the people in Washington, D.C., a group of people being the Congress, 2 houses of Congress, the Senate and the House, along with the president. They determine how to change government spending or taxation. And what we're talking about is changing it from what they had originally budgeted. So it's extra out of budget actions. It's not say, oh, we budgeted $20 million to go to the national parks. That's part of the regular budgeting process. If we decide, oh, hey, now we need to up the spending to 40 million, that will have an impact on the economy. That will be that fiscal stimulus, that 20 million extra that we're talking about here. Okay, and so that was fiscal policy. Moving into our third and final option, the decision makers for monetary policy are up in New York City. They are on Wall Street. This was originally by design by Alexander Hamilton. I don't know if you guys are Broadway musical fans like I am. I'm a total geek. And Hamilton the musical is coming to Spokane next year, spring of 2021. I already have my tickets. It's an amazing show. But anyways, Alexander Hamilton was the first treasurer of the United States. So we have him to thank, not necessarily blame, for the way that our country was set up. He was from New York, and so he wanted his offices originally to be in New York. He recognized the importance of the commerce and the activity that was going on in New York City. At the time, President Washington was from Virginia, and the original center of government was Philadelphia. Right? Remember where the whole Constitution Hall and everything happened, and the Declaration of Independence was all in Philadelphia. But eventually, there were a lot of founding fathers that wanted the capital moved to D.C., and ultimately it was placed in D.C. And so Hamilton was very particular about keeping the money away from the politicians even. So he wanted the money to be up in New York, and the politicians, he didn't trust them, down in DC. So this is clearly by design, and it's part of our checks and our balance system that we have today, which is really neat, right? So that regardless of what's going on in DC, when they're fighting about the budget and they're fighting about what to do with respect to stimulus or whatever, up in New York, the Federal Reserve can be acting on their own. They can be pumping out stimulus like crazy if they need to, without having to check with the government. Okay, they are not, there's a dotted line only. The president is not the boss of the chair of the Federal Reserve. Okay, and it's just like the president is not the boss of the Supreme Court either. Okay, and that's very intentional. So we're talking now about that group of people in New York City on Wall Street making decisions about the economy. That's called monetary policy. Okay, and so let's talk about that. So monetary policies, actions by the Federal Reserve. You can see in my notes here. So let me come back to my notes here. Actions by the Federal Reserve, particularly the group that votes and finally approves all of the options, is the FOMC, and that stands for Federal Open Market Committee, the FOMC. There are, in fact, 12 voting members of the FOMC, and I'll go through that structure in just a little bit, right? There's many more people that attend the meetings, add input, and are there for the debate and the discussion in the minutes. But when it comes time at the end of the meeting to vote, only 12 people on the FOMC actually vote. And we'll talk about how that is down the road. But what they're voting on is whether to conduct expansionary monetary policy or contractionary monetary policy. They're looking at all the data, reviewing what's going on in the different districts all across the United States, collecting all that economic data, and coming to an informed decision. The people sitting around that table, by and large, all have PhDs in economics and have extensive experience working in banking, working for the Federal Reserve, working in universities, doing research, all that good stuff. So they're very highly educated, very specifically focused on the economy. To contrast that just a little bit with the people down in DC, the people in DC are government officials, are elected officials, have so much other stuff on their plate. It's amazing. We ask them to do so much, right? They've got to do like national defense and education and healthcare, and they've got to deal with pandemics and all kinds of other stuff. Whereas the people in New York can just focus on the economics. So you should feel very comforted that the decisions that are being made in New York are going to be very sound, okay? Anyways, that's how it's typically been. There's always a fear that because they do not fall under the jurisdiction of the federal government, they're an agency all to themselves, and that none of them were actually elected by the people, that they could in fact go rogue someday. Can't imagine us economists, we're kind of boring and nerdy. But who would have thought that the National Park Rangers would go rogue someday? So anyways, the good news is that if the Federal Reserve were to go rogue, that the people in DC could do things to counteract it. They have their own set of tools, and they could just start doing stuff to counteract and counterbalance. We have these checks and balances. So don't be worried about the Fed having too much power. There is checks and balances on both sides. Okay. Anyways, so the two types of policies that the Federal Reserve would engage in, one is if they see that there's a recessionary gap, that we're falling short, we have excess unemployment, economy's just getting a little sluggish, we need to get it going, give it a kickstart, right? Kind of idea. That would be, we would need expansionary monetary policy. We need to expand our economy, push that aggregate demand curve out to the right. How we would do that, the Federal Reserve, the FOMC, has three very specific tools at their disposal. One of their tools is the discount rate, and it is closely related to the federal funds rate. How the discount rate works is, well, let me explain the federal funds rate first. So every night, all the commercial banks in the United States, they're highly regulated because they're so important to the economy. So all the banks in the United States have to meet their reserve requirements. The government says, the Federal Reserve says, to be a part of the Federal Reserve System and enjoy all these benefits, they have to obey all these rules. They say that for whatever their total deposits are at the end of the night, a certain percentage, and let's say the reserve requirement is 10%. It's pretty close to that actually in reality. So it's a good number, a round number, 10%. So they add up all the deposits that people made during the day, and then they, at the end of the night, how much they have, right? That hasn't been withdrawn, whatever's left over. And they take 10% of that number, and that number has to be sitting in the vault cash at the banks, at the various banks. So they have lots of branches, they can add them all up, right? Or it can be held at the Federal Reserve on behalf of the banks. So if you have a bank that's super big, like Citibank, they might not want to have that much vault cash sitting in their individual vaults, but Fort Knox is pretty safe. So we can send it to Fort Knox and the Federal Reserve will hold some of that money for us. When we need it, all we do is say to the Fed, hey, we need some of our money back, and they put it on a truck and they send it to us, okay? Not a big deal. So one of the things the Fed does is to hold reserves to help the banks hold reserves, okay? But anyways, so there's one person at every bank that has to, at the end of the night, add up the deposits, multiply it by the reserve required, and make sure that the bank is in compliance. Now, what's the chances that every single night your bank is going to be exactly in compliance? It's not going to happen. Extremely rare, okay? It's more likely you're going to do 10%, hey, I've got extra. Yay, I can go home and kiss the kids, right? Or, oh my God, we're short. What am I going to do? I'm going to get fired. No, you're not going to get fired. What you do is, over time, you've developed relationships with the other people who hold your jobs in the nearby area. And you guys actually have lunch together, you play golf together, right? So you call up your friend across the street. If you're at Citibank, call up your friend across the street who has your job for Chase over there, and you go, hey Bob, how's it going? Hey, I'm a little short tonight. You guys got any extra? And Chase guy goes, oh yeah, man, I was just about to go home. I got some extra. What do you need? And the Chase guy wires the money over to Citibank, and they're going to charge a little extra for this, right? For the convenience. And so Chase is going to make a little money because they lent Citibank some money overnight. The next morning, when the workers, the tellers, customer service reps come in the morning, they open up the bank and all the businesses have deposited money overnight. They've dropped off all their money bags. The bank is flush with cash again. So Citibank wires it back to Chase and says, thank you. So it's just an overnight loan, okay? The federal funds rate is the rate that banks charge each other. It's a bank-to-bank rate, and the Fed does not set that. The banks themselves determine what's an appropriate amount to pay each other, to charge each other, okay? However, let's say on a given night that you were short and you call up all your buddies and they were short. And it just turns out that everybody just ended up being short. Oh crap, what am I gonna do? At that point, you have to call the Federal Reserve because you can't be short. So you have to call, and this is like calling mom and dad once you've been a young adult and you have to say, oh crap, I spent too much money on pizza and beer. I gotta fess up to my parents. I need to make rent, right? Kind of idea. And you'll do this occasionally anyways. And so you call the Fed and you admit and you go, hey, I can't meet my reserve requirement. I need a little bit of loan to get me through to tomorrow. And the Fed will say, sure, but the Fed's gonna charge you a rate for that. And that's called the discount rate, okay? So those two interest rates, very, very closely related. The discount rate is actually slightly lower. The Fed funds rate is a little bit higher because the banks know that you don't want to call the Fed. So they'll charge you a little bit more for that convenience of, okay, you don't have to call the Fed and confess that you couldn't make your reserves, right? Okay, so that's what that rate is. Now, if the Fed were to raise that rate, what would happen is the banks would raise their rate accordingly, okay? So the banks, it's like a quarter point difference in some cases. So if the rate is 1%, if the discount rate is 1, then the Fed funds rate is like 1.25. It's not a huge difference by any means. But any increase in the discount rate would then signal an increase in the Fed funds rate. When the Fed funds rate changes, the banks then take action and take the opportunity to raise all of their interest rates slightly, depending by how much the discount rate was raised, okay? So that's how that works. So the discount rate is like the instigator interest rate that's gonna trigger a whole bunch of interest rates all down the line, all the way up to your mortgage rate, to your credit card rates, to your student loan rates, everything, okay? So if they were to raise the interest rate, that means that it's harder to borrow. You're going to be more careful about lending out your reserves. That's going to be contractionary. On the other hand, if the Fed lowers that discount rate, okay, that's a signal to the banks, oh, go ahead, keep lending out. It's okay, you won't get punished, right? Kind of idea. We want you to lend as much as possible. If you end up short, no problem. We'll give you an interest-free loan, kind of almost, okay? So a decrease in the interest, the discount rate is expansionary. An increase in the discount rate is contractionary. And so you can see here, expansionary monetary policy, decrease in the discount rate, okay? Recognizing that the Fed's fund rate would adjust automatically, even though that's a market-determined rate. Okay. Related to that required reserve rate is that the Fed could change that if they wanted to. So whereas right now it might be about 10%, if they wanted to expand the economy, they could lower it to 9, to 8, to 7, to 6, to 5. So at 5%, you can lend out a heck of a lot more reserves than you could at 10%. So a decrease in the required reserve rate means that the banks can lend out more money. And that's good. They lend out money for people to spend on their credit cards. People can buy new houses. People can buy new cars. Businesses can grow and all that good stuff, okay? And this happens really, really quickly. Those loans get made so fast. I tell you, I used to work as a teller way back in the day when I was an undergrad. And as soon as we got a big check in, like maybe $10,000 or more, someone would deposit more than $10,000, we were told to call the lending department right away. So let's say it came in at 9 o'clock in the morning, person leaves my window, I get on the phone, I call the loan officer, and I go, hey, we just got $10,000 in. The loan officer goes, hey, cool. I've got Joe over here that's looking to borrow $8,000 to buy his girlfriend an engagement ring, okay? And I swear within an hour or two, Joe is in my window collecting his $8,000. So those loans get made really, really quickly, okay? That lending out. So the banks are really efficient. They know how to execute. They know how to expand and get the money circulated in the economy. This is one of the arguments in favor of monetary policy. It's much more quick, okay? One of the downsides is it doesn't get to everybody, right? People who apply for loans have good credit ratings, right? The banks are going to say no if you've struggled to make your bills, if you're lower income, don't have any collateral or anything to back it up, you know, whatever, you might not get a loan. So in some cases, the monetary policy doesn't necessarily trickle down to everybody equally. That's a concern. So you have to weigh these pluses and minuses when you're thinking about fiscal versus monetary policy. All right. On the other hand, fiscal policy, everybody pays taxes. So we can give everybody a tax cut. And that will affect everybody across the board, not just people who use banks to get loans. Okay. Lastly, the third option that the Federal Reserve has at their disposal is the buying and selling of government securities, okay? And these are bonds, these are debt instruments that make up part of our national debt. So the national debt is an accumulation of a whole bunch of years' deficits, shortfalls, where the federal government has not balanced their budget successfully and had to borrow to meet their obligations, okay? It's the country's credit card, basically. And so in order to do that, they sell these pieces of papers, these debt instruments, and say, okay, you give me your money, I'm going to give you this piece of paper, and over so many years, I'll pay interest to you, and then at the end, I'll give you a big lump sum that I'll give back, right? That's how when the bonds mature, okay? And so the Fed, as part of the national debt, the Fed owns a big chunk of the national debt. They have it in their vaults. They've bought this up over the years, and they're financed through charging the commercial banks for services and so on. So the Federal Reserve pays for itself, and in fact, the Federal Reserve makes money. Unlike the U.S. Postal Service, the Federal Reserve makes a lot of money. The Federal Reserve could actually pay for the Postal Service, okay? Maybe we need to make that happen. Put them under the umbrella, okay? Because seriously, stamps are almost like money. So I could see that connection as a viable alternative to save our post office. But anyways, so the Federal Reserve is rich. They've got a bunch of bonds sitting in their vault. They also have a bunch of cash sitting in their vaults, okay? At any point in time, they can execute an open market purchase or sale of bonds. So think about it. One half of the vault, split your vault in half. One half has all these pieces of paper that are called bonds. The other half has all this money. At any time, I can swap them out. I can take the bonds and sell them to the public and take in money from the public and lock it up on the other side with the money. Or I could take my money and go out there and buy more bonds and put them in the other side. So an open market operation, either purchase or sale, is simply swapping two assets. It's swapping money for bonds, vice versa, okay? It has no effect on the federal budget. One of the benefits of monetary policy is these actions are not going to have to be paid back at any time, right? Because it's an even swap, okay? Right? We're just swapping one instrument for another. That's it, okay? So whereas changing government spending, changing taxation, that's going to throw more stuff on the pile of our national debt. That's going to hurt us down the road. Monetary policy does not, right? It's neutral in that respect. So if there is an open market purchase, if we need to expand the economy, what the Federal Reserve wants to do is take the money from the vault and give it to the banks. Give it to the banks so that the banks can lend it out and we can stimulate the economy, and that whole multiplier thing, rounds of spending, kicks off, right? Very much like fiscal policy, there's a multiplier effect with the money supply as well, okay? So if we need to expand, we take the money, we go out and we buy these bond instruments from the public. People have these in their portfolios, their retirement portfolios, their investment portfolios. We could go buy them from China, has a whole bunch of them, okay? Hopefully we're gonna buy them from domestic because we wanna stimulate our economy. So we're gonna go out and buy them from Americans in this case. We take our money, we buy a whole bunch of bonds, we take the bonds from the people, lock them up in the vault, and now the people have money. They're gonna turn around, deposit into their banks, and spend it. That's gonna stimulate the economy. All right, so those are the three expansionary monetary policy pieces. Lower the discount rate, making it easier for banks to lend out their reserves. Lower the required reserve rate, again, allowing them to lend out more than the previous night. And then an open market operation, purchase of bonds. And by the way, this purchase of bonds is done at the stock market, which is why the Federal Reserve is right across the street from the New York Stock Exchange. They can just call across the street and say, hey, we want to execute X $1 million of bonds today. Interestingly, it's really quick, efficient. They report this in the Wall Street Journal, so it's totally transparent. If you're paying attention, nobody's paying attention. Nobody wants to go and say, hey, look at the trading desk. What did the Fed conduct? Okay, I am. I get the email every day telling me exactly how much they did. But other than us geeky economists, you guys don't care. But you could find it. It's not like they're hiding it. All right? But no one's really paying attention. If they overshoot, and let's say they bought too many bonds, then they can turn around the next day and sell them back. At any time, they can conduct this swap out, okay? So one of the things about monetary policy, it's really fixable, right? It's really cool. Once we've sent the stimulus checks out, we can't go, oh guys, sorry, we made a mistake. You know, we sent you 1,200, we need 400 back. How many people are actually going to write $400 checks back to the government, right? So it's not as correctable on the fiscal policy side. But with the Fed, it is, okay? Another advantage of the monetary policy. And we'll get to this at the end when I do a little more comparing and contrasting. All right, give me 1 second. I told you guys I was getting really thirsty after my 3-mile run and my very, very rigorous game of hockey. It went into overtime, and my team ended up losing, so a sad day. Me and the little guy lost to my husband and my daughter, but give me a second here. Okay, I had to keep talking, make sure I wet my whistle. So those are the three expansionary. On the other side, just flip them and you'll see what can be contractionary. It's the same three tools. It's the discount rate, required reserve rate, and the OMO. But for contractionary monetary policy, we want to increase the discount rate, making it harder for the banks to lend out, okay? We want to increase the required reserve rate, making them hold more. And again, not lending out as many loans. That's going to contract the economy, slow down those loans, okay? And then a sale of bonds. They're going to take the pieces of paper out of the Fed vaults, give them to the banks or to the individuals, okay? In return, they're going to pay us money. We're going to take that money out of circulation and lock it up in the Federal Reserve. That contracts the money supply, right? And that's going to contract the economy. That money won't be working for the economy in that interim time period, okay? Again, contractionary monetary policy, increase in the discount rate here on my sheet, increase in the required reserve rate, and then an open market operation sale of bonds. All right, what does this look like on my ASAD model here? Whew, I realized by taking one sip I need more. And so with my expansionary monetary policy, which would be used when we see a recessionary gap, the LRAS is to the right of the short run equilibrium with the center of the X, okay? I'm falling short, I haven't gotten to potential yet. And so in this case, we need to stimulate that aggregate demand curve. So we would apply those three expansionary monetary policy tools, and that would have the effect, very much like fiscal policy, of stimulating the aggregate demand curve. So expansionary policy, either fiscal or monetary, is going to shift the aggregate demand to the right. On the other hand, contractionary monetary policy, any contractionary policy, either fiscal or monetary, is going to move the aggregate demand curve to the left. So the three contractionary tools, increase in the discount rate, increase in the RRR, and the open market sale of bonds, will shift that aggregate demand curve to the left and move us back to the LRAS. And we have an inflationary gap, where the LRAS is to the left of my short run equilibrium. As a result of applying the contractionary monetary policy, we will end up with lower prices and lower output, whereas the expansionary monetary policy, we're getting that demand pull inflation. We're getting some inflation along with our increase in output. We'll tolerate that inflation because we enjoy the increase in output if we needed it in the case of having a recessionary gap. All right, so now let's do some math. And so here's where the calculations come in. And so let's say that the change in the money, if I talked about that money multiplier, right? In this case, I'm using the double M, the MM. I use a single M for the fiscal policy multiplier. Here I'm using the money multiplier, MM. And that is found not by using the MPC, but by using the required reserve rate. So the money multiplier is equal to 1 divided by the required reserve rate. So let's say, for example, let's use that original example of 0.10. If the required reserve rate is 10%, the money multiplier is going to be equal to 1 divided by 0.10. When you put that into your calculator, you should get 10. So the money multiplier is 10. So what that means is, for every $1 that the banks lend out, they're going to stimulate the economy by $10. That is really cool, okay? All right, so let's say as a word problem, for example, that the Fed decided, they approved to purchase $100,000 in bonds. That's going to be expansionary right here. We're seeing a recessionary gap. So they're going to purchase $100,000 in bonds. We want to know by how much will that stimulate the money supply. And so in this case, you take money multiplier times the amount of the open market operations. So 10 times the 100,000, the money supply is going to expand by 1 million, and then that money can be spent hopefully on goods and services. Okay. Contractionary, now it's just going to be a sale of $20,000 in bonds. In this case, the required reserve rate 0.125. To find my multiplier, I do 1 over 0.125, plug that into the calculator, and I'm going to get 8. So the change in the money supply is then 8 times the amount of bonds that I sold. So 8 times 20,000, my ultimate expansion in the economy, the money supply, is going to be 160,000. So that's how you do those problems. Really straightforward, really simple algebra. In this case, it's the same formula. Whereas for government spending and taxation, we had slightly different. In this case, was expansionary, contractionary, monetary. There's only one monetary policy. There's only one formula. Okay. All right. Let's go on and talk a little bit more. I think that's the amount of the math. Yes, it is. Woo. But I've got some discussion. Some of it I've already talked about, right? Okay. Woo. Hey, we're done with the math, and I see a typo I have to fix. I'm done with the math. Let's talk more about these financial institutions. As you heard in the story, the commercial banks are very important. We need them to play along. We have in the United States that the banks are private profit maximizing firms, okay? They are not owned by the government. They are their own corporations. So we have Citibank, Chase, Bank of America, Wells Fargo. Those are our 4 largest commercial banks in the United States, right? Today, very, very big, massive corporations, okay? Have a lot of money, a lot of wealth. And there's tons of other banks of varying sizes on down from that, okay? Our commercial banks are our biggest and widest variety, from little banks to big banks, that we have, that are commercial, that deal with banking, okay? Those commercial banks, all of them, are required to be a part of the Federal Reserve, okay? But recognize their job, the commercial banks, they could care less about the economy. Their job is to make profit for their stockholders, okay? So they're privately motivated. That could be a problem, and that's why we have the Federal Reserve overseeing them, because, again, we don't want them to go rogue, okay, and crash the system like they almost did in the Great Recession, okay? They're making too risky of loans, and we had to say, whoa, time out, okay? We have to close the lid a little bit on them. Another type of financial institution that you often use when you are a college student or more of a young adult, right, first branching out, are credit unions, okay? And credit unions have some sort of membership requirement. So, for example, some large corporations have their own credit unions. Boeing has their own credit union. Washington State employees WSECU has their own credit union. Spokane teachers have their own credit union. So you have to be a Spokane teacher to be a part. Originally you did. They have since expanded in some cases that it's, if you live in Spokane County, you can be a part of this credit union. So there's some sort of membership requirement. They're very locally based and serve the local community. So you won't necessarily see Boeing Credit Union in Milwaukee or something like that, right? It's in this area here in the inland Northwest, for example. Okay, credit unions, they are nonprofit. They are not out to make a profit. They are out to provide very reasonable rates for their members. And in fact, if a credit union earns a profit, what they often do is will return that money to the members. I remembered one year I was in a member of the WSECU and I was teaching down in Pullman at Washington State. And one year, it's based on how much money you have in the bank. And as a college student, I didn't have a lot. But one year, what happened was I got a very, very small refund check from them. I was like, what is this? And, oh yeah, that's because we made too much money. We actually made a profit. We did so good. And we gave it back to our members based on how much money you had. So people who had more money got a bigger refund and I just got a small one. But anyways, so that's a really cool. They're not allowed to make profit. Okay. So credit unions are nonprofit. So at a credit union, you're more likely to get a better interest rate. They're not going to gouge you on those interest rates. And so credit unions will be very, very helpful in that regard. You'll get better interest rates and they pay slightly more on savings as well. It's all about serving their members rather than making profit for their stockholders, okay? The downside of a credit union is because they are membership based and because they are relatively small in limited geographic areas, they don't have access to a lot of money like the commercial banks do. So unfortunately what happens, whereas I said when you're younger and you're college students, you might be more likely to use a credit union, hopefully my goal is for all of you guys to eventually outgrow a credit union so that your needs will be bigger than what the credit union can actually meet because they just don't have as much cash at their disposal. So they may not be able to afford that new yacht that you want or that big mansion that you're going to go buy, right? So there's a limited amount they can do in terms of mortgage and yacht financing. Okay, so eventually, and investment opportunities as well, when you're going to have this huge portfolio, because you're all going to be, you know, amazing performers in all of your careers, whatever. You're going to just do a great job and totally outstrip me in terms of earnings. So I have this great vision of you guys going on to big and better things. So hopefully my goal is that you will outgrow a credit union and you'll need a commercial bank to meet all of your needs, okay? Savings and loans, this is if you've seen the classic Christmas movie, It's a Wonderful Life, right? It's a Wonderful Life is the classic telling, and if you haven't, go tell your parents they failed you miserably. Everybody should see It's a Wonderful Life, right? It's an amazing Christmas story, feel-good story. George Bailey runs the local savings and loan, and he's up against Mr. Potter, the evil commercial bank in town. Okay, and they're fighting over the constituents of Bedford Falls in New York. Anyways, savings and loans were very much like a different version of credit unions. They were very much serving the local community. They were about building for houses and local businesses in the community. Okay, it was savings and loans. It wasn't about all this other stuff that commercial banks do. Over time, ultimately, sadly, savings and loans got bought out and got outcompeted by both credit unions and commercial banks. There's still some of them lingering, so you'll still see them, but by and large, they're a very insignificant part of all of our financial institutions. They're very important, though, historically. We were very fond of our savings and loans. They were very important at one point in time, not so much anymore, but we do still include them when we're talking about the three different financial institutions. And again, savings and loans are pretty much small businesses. They can be for profit, but often they're not. So the profits are often reinvested right back into the community, okay? All right. How do banks create money? We kind of talked about this with respect to the Federal Reserve injecting money into the system through the use of the commercial banks, right? So let's start out, though, with what is money? When we're talking about money, what constitutes money and what things are not money? And so Money, very simply defined, is anything widely accepted for purposes of exchange. Give me one more second here. I apologize. So if you go to Disney World or Disneyland, you can get Disney bucks, and you can spend Disney bucks on any of the sites at Disney World or Disneyland, any of the hotels, any of the parks, any of the stores. So they have their own money. It is widely accepted in their little world, but once you go off of their property, your Disney bucks are no longer accepted. You can't go to the gas station that is just on the other side of Disneyland and try to pay with Disney bucks. They'll look at you like, what? So Disney bucks are not widely accepted. So they're not really money, okay? They're money on a certain very limited scale, but not what we would call money at the macro level by any means, okay? But money can be anything else that we agree to accept for purposes of trade, for exchange, okay? And so fiat money is what we have today. In the past, our money used to be backed by commodities. Used to be backed by silver, used to be backed by gold. We had the gold standard and we had the silver standard. We have gone off of both of those. And actually, I don't know if you guys know, the Wizard of Oz story is an allegory about moving from the gold standard to the silver standard, right? Before the ruby slippers, they were the silver slippers, and it looks better on color film, so they use ruby slippers for the Wizard of Oz, for Dorothy's slippers. But originally in the book, go read the book, it's really good, The Wizard of Oz, she wears silver slippers, and she's walking on the yellow brick road, which is the gold standard, right? Isn't that cool? And then Emerald City, green is the greenbacks, is the currency, right? How cool is that? If you didn't know that allegory, now you're gonna all go out and read, not only can you go watch It's a Wonderful Life, but now you're gonna go read The Wizard of Oz, right? But anyways, so in the past, what you could do is you could take your silver certificate, and I actually have one from like the 1950s, I think. My husband came across one, it's like a $5 bill or something. And you can take it and you can redeem it for a certain amount of actual silver. And that's really cool. And people felt that that gave money more validity, because at any time you could swap it out and they legally had to give you something really valuable silver, right? Not the case anymore. Our money is not backed by anything. If you took your $5 bill to the bank, what they could probably give you is 5 ones, okay? Or they could give you, 4 ones and 4 quarters, okay? They would swap it out for other currency, but you're not gonna get any silver or gold anymore. So what we have is money that's just backed by faith in the government, that the government's not going to default on their obligations, okay? So that is called fiat money, fiat meaning faith in Latin, okay? So it's not backed by any commodity anymore. All right, whew, sounds kind of scary, but it's not. The US hasn't defaulted as a nation. All right, the roles of money. So what does money do? And we'll get to measuring the money in just a little bit. But money serves 3 major roles. The most important is this idea of allowing us to conduct trade more efficiently. It's called a medium of exchange, and it eliminates the need for what we call a double coincidence of wants. So if I want a Big Mac, okay, and we didn't have money, what I would have to do is I would have to walk into McDonald's and say, okay, what can I give you to trade for a Big Mac? And they would say, what do you got? And I say, well, I got this really great lecture on supply and demand. Do you want to hear it? And they'd go, no, thank you. And I probably wouldn't get my Big Mac, would I? So instead, what happens is, instead of using barter, which is really inefficient because the other person would have to want what you're offering, right? My lectures in economics, which are really cool. But instead, I go to work at the university where they value my lectures and they pay me to give lectures. I take my money and then I can go to McDonald's and I can get my Big Mac. So the money is the go-between. Okay, it allows me to, on the one hand, work and get the money and then to go and spend it in a different market entirely. Okay, so it's a medium of exchange. It allows all of this trade to occur a lot more quickly than it would if we had to all sort ourselves and find out who had what I needed and wanted whatever I was offering. Crazy. Barter is very slow. Okay, another role of money is that it holds its value. One of my biggest pet peeves, and I think I tried to make this when I was talking about the data collection, I think, right, is that people will say, oh, a dollar isn't worth what it used to be. No, I'm pretty sure that a dollar bill in 1950 was worth $1. That same exact dollar bill, even though the dollar bill says 1950 on it, I can take a 1950 dollar bill. I would take it to McDonald's and I would say, I'd like to buy a large Diet Coke with this. it would be worth $1. It says $1 on it. $1 in 1950 is worth $1 in 2020. Now, what's different, as you know, because of inflation, the purchasing power of the dollar is different. Very, very different and very important. You guys are going to sound so much smarter now that you've had this class, and you're going to go out there and correct people when they say stupid things like, oh, money ain't worth what it used to be. No, it's still worth the same. And that's a really cool thing. So if I dug up, a pirate treasure chest and I found a whole bunch of $100 bills from the 1910s, right? I could spend those and they'd still be worth $100. They kept their value, but I may not be able to buy as much stuff. 1950, my dollar would have gone a lot further than my 2020 just buying a large Diet Coke at McDonald's, okay? But it's still worth $1. So it keeps its value over time. The money is printed on paper that is very durable and does last for a long period of time. So like I said, we still have those silver certificates sticking around from 1950s. They haven't eroded, haven't lost their values, okay? So it's a really cool attribute about money, that it holds its value. It doesn't depreciate. It doesn't go bad. Like you've heard of in the older days, right? Maybe back in the colonial times or whatever, our Native Americans in particular used maize or corn to conduct transactions. We used beaver pelts, things like that. Those things would go bad, right? The beaver would start to smell after a while. The corn would go rotten. That is not a good store of value. It doesn't keep its value over time. But the pieces of paper that we use for money do. The coins that we do, very durable. Okay. Lastly, what we use money for, and we talked about this maybe with GDP, is that we count things. We can count up GDP. We can count up people's salaries. So it's a unit of count. It's a ruler. It's a measuring stick. So we use money to measure things. And so that's what we mean by a unit of account. So we can compare. Okay. All right, so those are the three roles of money, why money is good and what money does for our economy. Again, keying on the most important being that medium of exchange and allowing our trade and interactions between markets to just go so much more efficiently. How do we count up all the money that is out there? Because if you think about all the different ways that you can purchase something at a market, right? The things that you can use to spend to get goods and services, that's kind of like money. But let me be clear. There's a difference between money and credit cards. Credit cards are not money. Credit cards are loans that have to be paid back. A debit card, on the other hand, does not have to be paid back. Once you've spent the money on a debit card, it's gone. It ain't coming back, right? Unless you put more money in the checking account, right? Next time you get paid. So no, debit cards, money, credit cards, not money, okay? Other things that are not money are food stamps, because that's just a transfer from one group who paid the taxes to another group who needs the food. So we call those transfers. Those are not money. And again, food stamps doesn't meet our definition of widely accepted. You cannot take your food stamps and buy a brand new BMW with them, okay? So no, they're not widely accepted. They can only be used for food, for example, okay? Gift certificates, same thing. They're usually limited to one store or one thing. And again, a gift certificate is a transfer. One person pays, the other person gets the good or service. It's not money. The one person buying the gift card, that's a transaction where money has been paid for the gift card. But when someone redeems the gift card, that's not money. Okay? The money was already spent in the original transaction. You don't want to double count. Okay. So what's left then, how we pay for goods and services, most often is M1. And what we call M1, this is our narrow definition of money. This is the stuff that we use on the front lines. Currency, coins, checkable deposits is your checking account and your debit cards. And then traveler's checks are still out there. Not a lot of people, older generations use those more, but we don't. We've gone away from checks. Everything's like cards nowadays, right? So a debit card and currency are probably the most common ways that you guys buy things when you go to the store, right? Okay, that's called the narrow definition is M1. But what we've done is we've realized there's a lot of other money that is somewhat accessible. There's a term called liquidity that your book talks about. And liquidity is how fast can an instrument be converted into cash so that we can spend it, okay? And so M2 is extremely liquid, but it does take one extra step to get to true liquidity. The most liquid is M1. M1 is the most liquid. M2 is slightly less liquid, but still very liquid in terms of our liquid assets, okay? So M2 is made up of, it includes everything in M1 plus some more stuff. We're going to add on to our currency, checkable deposits, and traveler checks. We're going to add on savings deposits and small CDs, certificates of deposits, are time deposits. You lend the bank money for a certain period of time and then they'll pay you some interest, right? These small CDs, by small, we mean under 100,000. Over 100,000 is called a jumbo. Small CD under $100,000. And then money market deposit accounts. Money market where it's tied to, it's an interest-bearing checking account, and you have limited amount of checks that you can write off of it. But it's still, you can write the check and spend it pretty quickly, okay? So M2 is a broad measure of the money supply. M2 is usually what economists are referring to when we use the term the money supply. We're talking about M2, okay? The broader definition. All right, so now we know how to measure all the stuff that's out there. And we do because the banks keep really good records. And every night they have to tell the Federal Reserve how much they have. So every night the Federal Reserve knows what the size of the money supply is for the whole country. Really cool. Another reason why they're on top of things when we talk about determining monetary policy. All right. Again, what we have in the United States, I've explained this already, is a fractional reserve system where the banks are required to withhold, set aside, lock it up in their vault, a small percentage of every deposit. So let's say 10%. 90% they can lend out, 10% they're putting in the vault, okay? That's a fractional. They don't have to hold the whole deposit in the vault. They are allowed to lend out a fraction of it, okay? And although the banks must keep a minimum, they are always welcome to hold more if they are nervous. If they see that there's a recession coming, they're nervous about worsening economic conditions, the COVID pandemic, whatever, banks can start to hold extra reserves, and they do, if they just don't want to make the loans, okay? So just keep that in mind too, because that could be something that limits the effectiveness of monetary policy. If the Fed is saying, hey banks, here's some money, go lend it out, and the banks are saying, hey, thanks for the money, we're going to sit on it, well, then it's not working the way that the Fed intended. So we need the banks to play along, and if they get extra nervous, they may not. And that's okay, we can understand, they're just being safe, they're being conservative, but it may take more fiscal or more monetary policy actions to actually have the desired effect, that's all, okay? So keep that in mind too. All right, so let's talk about this Federal Reserve System, what this works, this oversight of our banks, okay? Oh, and by the way, the Federal Reserve System, I said, when I talked, let me fly back here for a second, I forgot to mention. I said that the commercial banks are required to be a part of the Fed. The credit unions and the savings and loans are not required, but they can voluntarily join if they want to. They would have to pay a membership fee. Just like the commercial banks. The commercial banks are forced to pay the membership fee. The credit unions and savings and loans can voluntarily, and many of them do, because the Federal Reserve provides a lot of really cool benefits for all of the financial institutions that are members, okay? So all the commercial banks are members, many of the credit unions and many of the savings and loans are members on a voluntary basis. They could cancel their membership at any time, okay? Without any penalty. Okay, they just wouldn't get the benefits anymore. All right, it's like when you back out of AAA or something like that, you lose that roadside service. Okay, anyways, which is really good because I tend to get flat tires at a very high rate, or I tend to run out of gas. I do that quite often. You'd be surprised. Okay, anyways, so this Federal Reserve System, this extra layer of oversight and independent agency in charge of monetary policy came into being in 1912. Okay, it was passed, the legislation was passed in 1912, and the Federal Reserve actually started opening like January 1, 1913. Okay, so we did everything setting up 1912, got it into place, and it opened their doors in 1913. All right, set up as an autonomous agency of the federal government, and they drew the different districts based on population, whatever it looked like in 1912. So if you remember, 1912, a lot of our population was still east of the Mississippi. Colorado or California and Oregon and Washington, Portland and Seattle hadn't exploded. Phoenix and Las Vegas hadn't exploded yet, right? And some places in Texas hadn't expanded as much yet. And so the western districts of the Federal Reserve are huge geographically, right? We are in the 12th district in Washington state, along with Oregon and California and Hawaii and Alaska. And I think we have Arizona, and I think we even have Nevada with Las Vegas, right? That's huge, right? Colorado, Denver has like the Montanas and Idaho and Wyoming and those guys. So anyways, and Texas, Dallas has their own. But you can go and look at the map. I'm sure it was probably in the book, right? The 12 different geographic districts were drawn. They are still the same districts today in 2020. We keep talking about redistricting because, as you know, our population has come westward and south. We have a lot of people that have moved south into Florida and Arizona, right? A lot of snowbirds, things like that. Retirees looking for warmer weather. And so they talk about redistricting. They haven't done it yet. It's always something on the table. I mean, we might have done it this year, but except we had a pandemic come along, you know. Anyways, and so that's just to keep in mind when you look at the size of the districts. The ones out west are huge. The ones in the east are very, very small. Boston has their own. New York has their own. Philadelphia has their own. Maryland has their own. So it's just like boom, 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 boom. Atlanta, right? Chicago in the Midwest, Cleveland, St. Louis, okay? Those all have their own districts. So they're much smaller districts. Minneapolis district is pretty big. They might have the Dakotas now that I think about it. Minnesota probably has the Dakotas in their district as well. Minneapolis is a big part of the Fed. Anyway, so the reason for having these districts is because the conditions in those districts might be different. What's going on in Florida might be very different than what's going on in Washington. And we see this. For example, our Rust Belt was really struggling for a while. Our Midwest was really struggling with the collapse of manufacturing, right? But out in California with the tech stocks, everything's booming out there, right? So different districts have different needs. And so with the different regions, then the Federal Reserve can cater to the banks in their specific region. It's really cool set up that way, okay? Each district has their own district president, and then underneath that, several vice presidents and so on, just like a corporation, okay? And a whole slew of people working beneath them, okay? This whole structure beneath them, okay? And each district has branches. So whereas we are in the western, the 12th district, District 12, going back to Hunger Games on me real quick there. No, we're in the San Francisco district. So San Francisco is where the president is. The district president would be in San Francisco. There's a branch in Los Angeles. There's a branch in Portland. There's a branch in Seattle. There's a branch in Las Vegas. There's a branch in Phoenix. And there's a branch in Anchorage and Honolulu. Okay? So there's these branches that are satellites underneath the district structure. And the reason for that is if they need to get currency to the banks quickly, they can do that. So if we in Spokane have an emergency and our banks are out of cash, we just call the Seattle branch, and within an hour, they can have money sent to us on an airplane. Okay? So it's really, really quick. So there are these satellites. We don't have to wait for an airplane from San Francisco, for example. All right. So there's the idea. The regions have distinct economies and could be facing different challenges. All right. So there's 12 district presidents, one at each of the districts, 1 through 12, right? And then in addition, we have a board of governors. So like a corporation has a board, right? The Federal Reserve has a board of people who their job is to oversee the presidents and to oversee the district. And so there's 7 of these people. They are appointed by the president and confirmed by the Senate, very much like Supreme Court appointees, okay? And unlike the Supreme Court, though, the Federal Reserve Board of Governors have term limits. So they cannot serve more than a full 14-year term of their own. But if they came in and stepped in the middle of someone else's term, someone got sick, someone retired, left their term early, they can serve out the remainder of a previous term and then be appointed for 1 full term. You can never be appointed for a 2nd full term. Okay, so the most you could like ever serve is like almost 28 years if one guy says he works a week and says, I'm done, I'm out of here. And then you fill out the remaining, 14, 13 some years on his term and then have your own term, right? So it could be kind of a long term. Alan Greenspan did have a very long term back. He went from like 88 to 2006. He had a very long term because he stepped in early to fill somebody else's term that expired and then filled his own term. And he was a very, very strong and very well-known chairman of the Federal Reserve that was very instrumental for Clinton having his very, very long 8 years of expansion in the 90s, one of the longest expansions that we had as well. And President Clinton was the last president to ever have a budget surplus. And a lot of that was thanks to Alan Greenspan. It was also thanks to President Clinton being a very wise guy in letting Alan Greenspan run everything. President Clinton was like, you know what? I've got all this other crap I have to deal with down in Washington. You go ahead, you run New York. If you need me, let me know. Otherwise, you're in charge of the economy. I got everything else going on here. And President Clinton was kind of smart in knowing that he didn't have the expertise in economics, and it was better to let the experts run it. It takes a very humble president to be able to admit that and to give up the power, right? For example, I'm not sure that the current president has that personality that would allow that to happen. Some presidents are, in fact, very controlling control freaks. And that's okay, because as people, some of us are very controlling, right? Anyways, just it depends. Every president, different personality, different relationship with the chairman of the Fed. I'm just saying that President Clinton had the type of hands-off approach, the relationship that he had with Alan Greenspan, and it worked out because Alan Greenspan was a very capable manager of the economy. All right. So anyways, the idea is these guys serve 14 years. Every 2 years, one of the terms comes up for reappointment. So a single president, because they can only serve 2 terms, right? A single president in 8 years can only appoint 4 board of governors. So he can't stack the deck. We've only had he so far. When we get our female president, we can say she can't stack the deck, right? So the president cannot stack the deck like the Supreme Court. Okay, we would worry if the president was able to get all of their favorite people on the Supreme Court. Okay, so every 2 years, one of the members of the Board of Governors comes up for reappointment, goes through this process. The president appoints somebody, Congress approves it, and they're on the board. Of those 7 Board of Governors, one of them gets chosen to be the chair, and the chair just runs the meetings and is ultimately the figurehead who delivers the speeches, talks with the media, has the most amount of responsibility on their shoulders, but ultimately it's the whole committee that makes the decisions, okay? The president does appoint the chair, and they can change the chair at any time, but it has to be to one of the 7 board members. They can't go off the board and just bring in their best friend or maybe their son-in-law and put them on the board. That would be really scary, right? So no, the president can choose one of the 7 Board of Governors to be chair. If they are appointing a new person that year, they could appoint them chair at the same time, right? And that has been done before, but it can only be done a few times, right? As while they're president, okay? So keep that in mind. Chairs tend to be very stable. Like I said, Alan Greenspan was chair of the Fed for a very long time. It's good to have stability. It's good to have the same face running the Federal Reserve. That builds confidence in our economy. Okay? All right, so that's how it works. We got the 7 people overseeing the 12 district presidents. And those guys, the 12 district presidents and the 7 members, all have PhDs pretty much. They all have been either in commercial banking or in the Federal Reserve System for a long time. Lots of years of experience. Very, very smart people in there. The FOMC only has enough spots for 12 people to vote. So what they do is, it's a decision-making committee, and they serve on the committee. They take the 7 Board of Governors, the New York president, because the meetings are held in New York, the New York president has a standing seat on that committee, will always be represented on that committee. They're the most important seat because they're in Wall Street, right? And the importance of the financial district and everything like that. So you get the 7 board members plus the New York district president, whoever it happens to be, will always be on the committee. The other 4 seats to make up the 12 voting members rotate amongst the other 11 district presidents. Okay, and they rotate every 2 years. So one rotation, it might be, Boston, Cleveland, Dallas, San Francisco. And then the next one, it might be, Denver, Chicago, Philadelphia, and DC or something. So anyways, they rotate, okay? That doesn't mean that the other presidents are off the hook and don't need to come to the meetings. Everybody comes to the meetings. It's just when it comes time to vote, only 12 people at the meeting get to vote, okay? Are the official members of the FOMC who get the heat if they make a bad decision. All right, so there we go. That's how the FOMC, so they're the ones that determine the monetary policy, and they determine the OMO, they determine the discount rate and the required reserve rate, okay? After these meetings, then the chair meets with the press, gives them a briefing and all that good stuff, okay? And everything is visible, the minutes are recorded. Sometimes it's filmed, sometimes it's not. Sometimes they go into a closed session and they'll just send out the minutes, a version of it, right? Oh, don't put this in the minutes, right? Anyways, but it's very, very open for the most part in terms of if you're interested. Sometimes it's very, very boring. All right, so other things that the Fed does on a day-to-day basis, in addition to overseeing monetary policy, they do check clearing for the member banks. So they facilitate the movement of one person writes a check in San Francisco and sends it to a company in New York. The New York company deposits it in their bank in New York, and the bank in New York needs to get the money from the San Francisco bank, right? So you have to swap this money. It all goes on. The Federal Reserve is a big computer network, and everybody has accounts at the Federal Reserve, and the Federal Reserve just switches buttons and just moves the money all over the place. Money's flying all over the place every second of the day, right? Kind of overnight in particular, they're clearing all these checks, right? Super, super speedy, efficient thing that the banks and even the savings and loans and the credit unions like. So this is one of the aspects that a lot of the institutions that are not required to be members, they choose to because they like the check clearing services. They get their money from other banks a lot more quickly. Okay. Additionally, the Fed is responsible for setting rules, to auditing the banks, to make sure they're not doing anything illegal, to make sure they're all in compliance, that they're holding the right reserves, and that their processes are correct. They have enough safety cameras, all kinds of rules. So they monitor the member institutions for compliance. They also, like I mentioned before, will hold the reserves because they've got big vaults locked up, right? Big security, okay? They also provide currency. Now, this is super cool. The Fed does not print the money. Again, checks and balances. The money is printed in DC. If you ever have a chance to go to DC, go and take the tour. There's so many Smithsonians and so many museums and so many cool things. You got to go see the FBI and the Pentagon and obviously the Washington Monument, the Lincoln Memorial, the White House, blah, 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 blah. One of the really cool other places to go see, the Holocaust Museum is really good. But you should go to the Bureau of Engraving and Printing and watch the money being made. It's really cool. Okay, I'm a geek, I'm an economist, but no, trust me, it's really cool. Anyways, and so the money is printed and engraved itself in DC. The sheets of money are then sliced up and sent, the big stacks of money are then sent by helicopter to New York and locked up in the Fed vault. Okay, and then it's the Fed's responsibility to disseminate that to the other district banks as needed. We do not print money to pay bills. The only reason we print new money is to replace worn out money. So one of the jobs of the commercial banks, the savings and loans, and the credit unions is to figure out money that no longer will go in the vending machine, okay, because it's all limp and worn and it's been washed too many times or it's crinkled or the dog ate it, all of that bad money comes out. They take it to the bank gives them a crisp new bill, right? In exchange, and then the bank sends the bad money to the Fed, and the Fed sends them brand newly printed bills, okay? It's a swap out. It's not, we don't print money, oh, we got all these bills to pay, just print some money. No, we would have done that for the national debt. We wouldn't be sitting on $21 trillion worth of national debt if all we had to do was print money to pay it off, right? So no, we don't do that. We don't print money to pay bills. We print money to replace bad money. Okay, mutilated, when I say bad money, mutilated money. Sometimes if it's a drug deal and we're worried about cocaine being in the money, right? Something like that, laced with cocaine. We don't want a little kid to grab that dollar bill and put it in their mouth. So if it's a drug deal gone bad or something, we'll take that money out of circulation. And the Fed will do that and send in brand new bills. Okay? So they provide currency as needed to get rid of what we call the mutilated, destroyed notes. All right. Additionally, they determine the monetary policy, and they also are a source of a lot of economic data. Hey, you went to FRED, Federal Reserve Economic Data, to get all kinds of data about the macroeconomy. So one of their jobs, in addition to all these other jobs, is to provide resources for the public to learn more about our system. All right. Whew, we're running out of time here. I'm going to take one more sip. I apologize. This has gotten long, but I do want to wrap up and finish up tonight. So I am going to plod on. So I appreciate you guys hanging in there for my final concluding comments. All right. Comparing. Should we use fiscal policy or monetary policy? So we're looking at a gap. We're looking at a pandemic, a COVID-19. Honestly, my first thought is going to be, it's all hands on deck. Hell yeah, we're using both. Guns blaring. Congress, you do whatever you can. Fed, you do whatever you can. Pump the money in the system. Everybody's working. Okay, that's one scenario. That's the doomsday scenario that we're in, right? Okay, we all get on board and we all start working together. Other cases where it's not so dire, where the economy is just showing signs of slowing down or just showing signs of overheating, okay? We can decide, do we want to take a fiscal policy action or do we want to take a monetary policy action? Which should we use? So let me talk about the advantages and the disadvantages, okay? So fiscal policy, one of the advantages, people feel more comfortable. These were elected officials. We voted these guys into office. We know what we're getting. They campaigned. We trusted them, right? Kind of idea. We don't know who the guys hiding in the offices in New York are, right? I don't know their names, right? I do. You don't. Anyways. And so it's the known thing. Well, I trust them a little bit more. Their faces are in the media. It's our senators. It's our representatives, it's our president making these decisions. We trust. Does that make sense? Okay. Another advantage of using fiscal policy is, again, it's very public. It's in the media. It's very visual. It's dramatic. They make a big scene about it because they want to show their constituents, look what we did for you, right? Kind of idea. So this is reassuring. So that's one of the advantages of opting for fiscal policy. When we did those stimulus checks, it made people calm down. Okay, we're on it. We hear you. We know you need some money. Here you go, right? Kind of calmed the situation. People sometimes don't understand what the Fed is doing. They haven't had this fabulous class, macroeconomics, at the college level. Not everybody goes to college. Not everybody gets this cool information, right? And so if people don't understand, the Fed can be over here yapping. Look what we're doing. Look what we're doing. People are like, yeah, great. I don't know what you're doing. Okay, and it doesn't calm them. So those are some of the advantages of using fiscal policy, why we would want to use fiscal policy in some cases. On the other hand, fiscal policy is not without its problems. Some of the issues of choosing fiscal policy over monetary policy, for example, is that by changing G and changing T, you're going to end up with a deficit possibly at the end of the year. Those are expenditures you didn't count on, or change in taxes you didn't count on, messing with your budget, making it likely your budget isn't going to match, and you're going to have to throw some more on the national debt. Okay, and that can be bad, all right? When you have too much on your credit cards, you know the consequences. It's going to take longer to pay it off. The interest payments get bigger, yada, yada, yada. Okay, so that's one of the concerns about using fiscal policy. It's not neutral like the monetary policy in some cases. Okay. Additionally, you've got three different groups working on the same issue, and they may have three different agendas going on. Imagine you could have a House that's one party, the Senate that's a different party. Imagine that. What does that look like? A House that's Democrat and the Senate that's Republican. Gee, I don't know. Looks like a lot of gridlock, right? And so you can end up arguing and taking forever. So to get the legislation, the fact that we got those stimulus checks so fast, that was that bipartisan cooperation, that was awesome, but it's not common. Okay, these guys clash with each other if you have House and Senate of different parties. If you have them with both the same party, and even best scenario in terms of getting fiscal policy passed, not necessarily for governing, for if you're on the other party, you may hate this scenario. But if you have a House and a Senate and a president, all of the same party, you can get a heck of a lot done for that party's agenda. Okay, I'm not saying that's good or bad. I'm just saying in terms of that's efficient, right? All right. But anyways, so having to craft and hammer this stuff out. The House wants one thing, the Senate wants this thing. Oh, there's bartering, cooperation, deals, backdoor deals being made, so on, right? The president could veto it, send it back. Oh, so it could be a lengthy process. Whereas the Fed can call a meeting, they can Zoom, they can vote, boom, within an hour the action's taken, and the banks can have their money. Okay, that quick. So one of the things is that there's a lag, a slowdown with the process in fiscal policy. Even after the legislation passes, it was still a couple weeks till people got their stimulus checks. We had to work out the implementation. We had to figure out, how are we going to get the money to people? Well, some people have their bank accounts on file through the IRS. Some people don't trust the banks or trust the IRS. So they have addresses. Okay, well, let's mail them checks, right? Okay, what about people that don't have addresses on file or PO boxes? What are we gonna do? And so there's this implementation, the devil's in the details. So it's a delayed process of getting the stimulus out there. It could be weeks, months before we see the full impact in the economy. Okay, so just keep that in mind. If you're thinking the fiscal policy sounds like a great idea, it does, but when it comes to implementing it, it's a little slow. That's all. And again, lastly, we send you guys the money. The government sends you your stimulus check, and some of you go on a cruise overseas with it. What in the hell are you thinking? You're supposed to spend that money here in the United States. Or worse, some of you pay off your credit cards or you put it towards your old student loans. No, we need you to spend it on new GDP, new stuff produced this year. Okay, they don't come with instructions. The checks just arrive. It's just a wire transfer into your bank. Hey, I got money, right? So sometimes the public doesn't know what to do with it. Or, like the banks, the public is hesitant. They're nervous. They're scared. They want to hold on to it. I might become unemployed. I might need this money. And that's not going to expand the economy as much as we had hoped. And it's not bad. I'm not saying people are wrong for doing that. I understand. I'm just saying it limits the effectiveness of that fiscal policy action. Okay? So pros and cons, pros and cons. I'm not saying don't do it. And in fact, during a pandemic, let's do everything, right? Or during a really bad recession, all hands on deck, right? Monetary policy, on the other hand, some of the advantages of monetary policy, like I've mentioned repeatedly, these guys are professional economists, years of experience, bam, they know what they're doing, and they agree, right? Reaching a consensus amongst 12 committee members is a lot easier than reaching a consensus on, 435 House members, 100 senators, and a president, right? That's a lot, 536, right, people. So it's a lot easier to reach a consensus with the FOMC. Additionally, like I mentioned when I was talking about the monetary policy, we can do it with small doses, small amounts of bonds can be bought and sold, or big doses. Large amounts of stocks and bonds can be, of government bonds can be transacted, right? So that's really cool flexibility. We can do it behind the scenes, little tinkerings, or whoosh, big announcement. We're going to do $3 trillion worth of stimulus, right? Kind of idea. And everybody freaked out because they thought that $3 trillion by the Fed was going to the national debt. And no, you're absolutely wrong. So that was actually a cool thing that the Fed said we're going to do $3 trillion in open market operations. You should have been like, yeah, way to go, Fed. Okay. Anyways, so because it is small or large and it can be done quickly, it can also be corrected. We can always go, oops. Hope nobody's paying attention. Let's go and fix that one. Okay. And they call across the street, can I have that transaction back? Can I have a mulligan, a do-over? And the desk will go, yeah, no problem. Okay. So super easy. And again, the biggest advantage, it doesn't affect the national debt. Okay. Don't have to be paid back. On the other hand, there are some disadvantages. It's not like monetary policy is totally 100% wonderful and fantastic, right? Some things to think about. The FOMC is not elected. Right? And you don't know who these people are. They have great pedigrees, but who are they? Where are they from? And only the 7 board members are appointed, right? The district presidents have worked their way up, and they could be just commercial bankers or something, that have found their way into the Federal Reserve. But they will have advanced degrees in economics, trust me. One of the disadvantages, right? The actions are not always visible. It's like buried in the Wall Street Journal, okay? They're doing this stuff behind the scenes to make sure that the economy flows well. And it's kind of nice to not have to worry about it as an individual citizen, but yet it's kind of like, what are they doing over there? What are they doing in that building? Okay. It's kind of nice to have some transparency, a little bit more. That's concern, that's all. And then, although it's very unlikely, I mentioned I made this joke before, right? The FOMC could just say, you guys down in DC don't know what you're doing. We're going to do this, and just go totally rogue and go totally against whatever the president and Congress have as their agenda, right? And say, screw you guys. They could. It's not likely. It's never happened yet. Who knows, right? Like, who would have thought the park rangers would go rogue, right? And have the alt park rangers social media accounts, right? I love those park rangers. They're amazing. Anyways, and so along with the other scientists, I think NASA to a certain extent went alt for a while. Anyways, although it's unlikely, if they did, don't worry. We have the checks and balances that Congress can counteract it, okay? So it's not like they're gonna run the economy into the ground and just totally tank it when these guys are gonna run off to Bermuda with their millions, right? No, the Congress has the ability to counteract any of that through the opposite policy, okay? There's these checks and balances. All right, so finally, although it's ideal if the FOMC and the federal government work together, come to an agreement, you guys do this, we'll do that, right, so on. Or in the case of the Clinton administration, hey, Fed, you guys run it. If you need us, let us know, kind of ideas. Either however they work out the balance between the administration and the Fed, that's fine, that's individual. Whoever president has the right to determine that, right, for themselves. But just know that there's the checks and balances, that one group can counteract the other group. Okay, so if Congress starts doing things that the Fed is going, oh my gosh, you're not thinking this through, it's going to screw the economy up, right? The Fed can start taking action to counteract it. Okay, so it's nice that there's this checks and balances, that we have this dual system. Okay, so that's the end. That's the wrap up. That's what I want to leave you with, that you are in good hands, that we've got two groups with very different, distinct tools at the ready, which can be comforting. We have 5 tools altogether, 3 monetary and 2 fiscal, that can be used. And they also kind of, have to watch out for each other and make sure that they're on the same page. And if not, then they can check and balance each other. So it's a really cool system. I love it. That's why I'm an economist, but that's what I want to leave you with. So I think that's it. That's all I want to say. I think I've gone long. I apologize, but I did want to get this information out to you so that you know what to study and what's important for the exam. And a lot of this was in the chapter, but I just wanted to hit the highlights for you. And again, I just love telling stories. This is my lecture I would be giving in person and interacting with you guys a little bit more if we were in person, but unfortunately that's not going to happen. So anyways, hopefully now you have enough information that you can finish that homework and get working on the next practice exam and start looking towards that final exam. And the light is at the end of the tunnel. You guys, we're going to make it. I am so proud of you all. I want to say that again. Those of you that are still working hard, kudos to you guys, okay? All right, make sure that you're paying attention to my announcements, that you saw the extra credit opportunities, and that you saw that the quizzes and the exams will have 2 attempts each, a little bit of a cushion, a reward for those of you who have been working so hard, and, just a little incentive. I know you're under a lot of stress at the end of the quarter, and sometimes that just takes a little bit of stress as you're trying to get final projects done and managing all your work at the end of the quarter and all of your classes. I understand. I was a student once too. So I like to give you that little bit of, you guys have been working so hard, you've earned it. You've earned your second attempts. Okay, so enjoy them. Let me know if you have any questions. Keep working hard. I am going to stop my screen share and say goodnight. Let me know if you have any questions. Come to my office hours, shoot me an email. Otherwise, keep working hard. All right, see you later.